let's be honest about what we're all watching. You see a team like the Utah Jazz, leading a game, and then suddenly benching all their stars for the entire fourth quarter. It's not a strategic move, it's an embarrassment. It's a visual surrender. For decades, this was unthinkable. Owning a sports team wasn't just a financial transaction, it was a badge of honor. If you lost, you didn't just lose money, you lost face in your city. Your reputation was tied to the scoreboard. But the scoreboard is starting to matter less to the people in charge. A new wave of owners is entering the league, and they don't view the team through the lens of a fan, but through the lens of a portfolio manager. For them, a basketball team is just another asset, treated like a Wall Street investment. And when your primary goal is maximizing financial return, winning becomes optional. It's a nice bonus, certainly, but it's no longer the main objective. This shift leads us to a single, critical question: why have these ultra-wealthy owners become so comfortable with losing? The answer is a two-word phrase that is reshaping the entire sports landscape: private equity. Today, the numbers are staggering. Nearly two-thirds of the NBA, over half of Major League Baseball, and a significant chunk of the NFL and NHL are now connected to private equity. In 2024 alone, private equity poured over $31 billion into sports deals. This begs the obvious question: why do billionaire team owners, people who already possess enormous wealth, need to bring these financial firms into their exclusive club? To understand the motive, we have to first understand the mechanism. Private equity firms are essentially pools of capital. They gather money from massive institutions and wealthy individuals to buy control of companies. They could buy a restaurant chain, a tech company, or, as we're seeing now, a basketball team. Their model is simple: buy it, change it to make it grow faster, and then sell it for a massive profit. They often do this by cutting costs, restructuring debt, and streamlining operations. Because they are private, they operate outside the public eye, making decisions that can have massive consequences without the scrutiny of the stock market. This model has already bulldozed through huge parts of the American economy. Iconic retail chains like Toys R Us were loaded with debt and collapsed. Hospitals and nursing homes have been restructured, sometimes at the expense of patient care. Even your rent is likely higher because private equity firms have gobbled up housing. It's a model built for one thing: maximum return, regardless of the human cost. So, how is this model being applied to your favorite team? The recent sale of the Boston Celtics provides the perfect case study. On the surface, it was a heartwarming story. Bill Chisholm, a lifelong fan, finally bought his childhood team. It was the ultimate dream come true. But that's the fairy tale. The reality is a masterclass in modern sports finance. Chisholm, despite his wealth, simply didn't have enough cash to buy the Celtics alone. To bridge the gap, he turned to one of the most powerful private equity firms in the world, Sixth Street. On paper, the arrangement looked clean. Sixth Street was just a silent financial partner, a minority investor content to sit in the background while Chisholm became the face of the franchise. But behind the curtain, the power dynamic was flipped on its head. Here's what actually happened. Chisholm approached Sixth Street to partner on the bid. Sixth Street then committed more capital to the deal than Chisholm himself, a move that technically violated the NBA's ownership rules regarding how much a private equity firm can control. To get around this, the Celtics publicly announced the sale with Chisholm as the lead buyer. This public validation made it easier for Chisholm to raise money from other investors, allowing him to eventually buy down Sixth Street's stake to a league-compliant level. By the time the deal was legal, the power had already been established. Chisholm could not have made his dream a reality without Sixth Street. Both sides know this. Sources close to the firm indicate they backed Chisholm specifically because they knew he would be the perfect public-facing owner, a local fan who would deflect attention away from their control. But their control is very real, baked into the structure of the deal. Sixth Street negotiated something called a preferred share. This isn't just a slice of ownership, it's a financial shield. If the Celtics lose value, Sixth Street gets its money back first. If every other owner loses their entire investment, Sixth Street walks away unscathed. They own perhaps 15% of the team, but their influence and financial protection are vastly disproportionate to that number. They control the purse strings, and in the world of professional sports, that gives them a pipeline to power. This power structure has already influenced major basketball decisions. The decision to move on from key players like Marcus Smart and others wasn't just about basketball fit. It was also about the bottom line. Keeping a championship core together incurs massive luxury tax penalties. When private equity is involved, the balance sheet often carries as much weight as the roster sheet. The goal is to manage cash flow, not just collect wins. This influence multiplies when firms own stakes in multiple teams. Sixth Street also owns a piece of the San Antonio Spurs. So, if the Celtics and Spurs meet in the playoffs, what is the firm's incentive? Are they genuinely rooting for one team to crush the other, or is their ideal scenario a long, profitable series that maximizes their return, regardless of who wins? When the same financial entity has a stake in both sides of a competition, the purity of the sport is inherently compromised. This isn't about villainizing Bill Chisholm. By all accounts, he is a genuine fan. But he is also the perfect archetype for this new era. He has enough money to dream of ownership, but not enough to make it a reality alone. He is the ideal conduit for private equity, a passionate face for a financially driven machine. To understand why this is happening everywhere, we have to look at the broader trend. Firms like Arctos Sports Partners are leading the charge. Founded in 2019, Arctos isn't trying to buy teams outright, they want to buy pieces of them. They provide cash to existing owners, giving them liquidity without forcing them to sell the whole team. As of late 2024, Arctos has raised over $7 billion and invested in nearly 40 different properties, from the Lakers and Warriors to Liverpool FC and PSG. They were perfectly positioned to capitalize on the leagues relaxing their ownership rules, starting with MLB in 2019. The reason sports are so attractive to these firms is simple: financial stability and explosive growth. Unlike volatile tech stocks, American sports teams are a safe bet. They are scarce assets with a monopoly on a product people love. Between 2002 and 2021, NBA team values grew by over 1,500%, absolutely crushing the S&P 500. The rise of global streaming has opened up massive new revenue streams, making teams even more valuable. But here's the catch: that value is largely theoretical. It's equity, not cash. You can be a billionaire on paper but be cash poor because your wealth is tied up in the team. And running a winning team is expensive. Paying superstars, covering luxury taxes, and funding state-of-the-art facilities drains real cash every single year. This gap between paper wealth and operating cash is the exact opening private equity exploits. But is private equity inherently destructive? The Los Angeles Dodgers offer a compelling counterargument. The Dodgers, owned by Guggenheim Partners, represent the best-case scenario for private equity in sports. Their model was simple: spend aggressively to win. They signed global superstars like Shohei Ohtani and Yoshinobu Yamamoto, betting that a winning team with international stars would cultivate a global fan base. It worked. Today, a huge percentage of Japanese tourists in Los Angeles make a pilgrimage to Dodger Stadium. The Dodgers prioritized long-term prestige and franchise value over short-term, year-to-year profit maximization. They are using the private equity playbook to build an empire, not just strip it for parts. And that is the fundamental tension. There is no rule forcing a private equity firm to be patient like the Dodgers. The history of the industry, from Toys R Us to nursing homes, shows that the default setting is often cost-cutting and short-term flipping. The unspoken contract between fans and owners, where fans invest their emotions and owners invest their money to win, is being rewritten. The people now gaining power are the ones with the least emotional stake in the game. However, to end on a note of doom and gloom would be to ignore the one group that still holds immense, untapped power: the fans. While you don't have a seat at the ownership table, you control where your attention and your money go. We saw this in Europe with the attempted Super League. When the biggest clubs in the world tried to create a breakaway, closed-shop competition, the fans revolted. They boycotted games, they blocked buses, and they made their voices heard. Within 48 hours, the project collapsed. Team owners admitted, privately, that they underestimated the collective power of the fans. They know that without your passion, the whole business model falls apart. Private equity is not going away. It will continue to influence how your team is built and who wears the jersey. It could turn your franchise into the next Dodgers, a global powerhouse willing to spend. Or, it could turn your team into a hollowed-out shell, like a Sears or a Toys R Us, stripped for parts and left with a legacy of a lost season and a balance sheet that made someone else very rich. Understanding this new reality is the first step in deciding what to do about it. Your caring, your attention, and your passion are still the most valuable assets in the game. Never underestimate the power of redirecting them.